Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. And today I wanted to go over the process of getting a mortgage with bad credit. Over the past year, a lot of people have seen their credit scores go down by quite a bit as people lost their jobs or were laid off temporarily and couldn't make those payments, be it credit card, your auto loans, lines of credit, anything that reports to the credit bureau. A lot of people had to be late on those payments through no fault of their own, just because they were laid off and couldn't work. So when you can't get financed by the big banks, there are still ways to get a mortgage with bad credit. And in this video, I just want to briefly go over that process. So today we'll go over what is bad credit, some of the signs of there being some credit issues, how to get a mortgage with bad credit when you're purchasing a house, the process of getting a mortgage with bad credit when you're refinancing your own house, which is often quite a good idea as it will help actually fix your credit. And finally we'll go over some tips on how to fix your credit in anticipation of getting that first mortgage. So first off, let's just briefly go over what we're talking about when we're talking about bad credit. So Equifax, which is one of Canada's main credit bureaus, actually lists bad credit as anything under 580. Well, that can be a little bit deceiving. So with the way it works with A lenders, that's your primary lenders, the lenders that you see their rates advertised as right now around 2%. Those lenders, the very minimum credit score is 600. So a good indication if your credit's below 600 is that there has been some missed credit card payments. There might be some stuff in collections. There could be some missed auto loan payments. So really anything below 600 and we are in that bad credit spot. That's definitely 1-to-1. Below 600, we're in bad credit financing. With that said, just because you're over 600 doesn't mean that we're necessarily not in bad credit financing. So you can have over a 600 credit score and still be considered bad credit if there's a collection or if there have been a few missed payments in the past. Some people do have enough credit, enough lines of credit, enough sources of credit that they can be over 600 and be really good on most of their sources of credit, make all their payments. But if a few of them slide, the lenders will still consider that credit bureau to be a little risky to give the prime lending rates. So today we'll just go over the process of getting a mortgage for a home purchase if you fall into that category of having bad credit where we can't deal with the prime lenders, with those low rate lenders, and have to go with what are called B lenders. The process of getting a mortgage for a home purchase is a little bit different when you're dealing in that alternative credit industry. So whereas with a prime lender, you apply for a pre-approval, you buy your house, you put in your income documents, everything's fairly cut and dry. It's a little bit different when we're into that bad credit or B lending space. So number one with B lending is because there's been some credit issues. B lenders loan a lot more on the property itself, the house that you're choosing to buy, than they do on the borrower itself. So because they're lending more on the property, they want to have a larger down payment. Minimum down payment on the B lending space, for the most part, is 20% down. So that will give the lender enough equity if there is an issue with the mortgage that they won't lose money should they have to take the house back. It's not a pleasant thought to think about, but it's how the mortgage lenders view alternative credit financing. With that said, the 20% down isn't the only thing that needs to happen with B lending. Because they're lending on the property itself, all B lenders are going to want to see an appraisal. They're going to want to make sure that the house that you're purchasing is worth what you're paying for it. So, because there will need to be an appraisal, that does complicate the offer process a little bit, as I always 100% recommend that there be an appraisal condition put into your offer to purchase. Sorry. Just because if the appraisal does come in lower, then you're on the hook for that difference between what you paid and what it's worth, and the lender's still going to want to have 20% down. So in addition to having the 20% down payment, if there's been some major credit issues in the past 2 years, the lenders are also going to want to see that you have no collections and all of your current lines of credit, credit cards, auto loans, everything that you currently have access to is up to date and has been paid up to date as of recent. So there could have been a collection in the last few years or some late payments in the last few years. But as long as those collections are cleared up, then we're okay with 20% down financing. With that said, you still do have to have standard income requirements, so we'll still need a job letter, recent pay stub, and your last 2 years T4s, just to ensure that you be able to afford the payments, even though you have 20% down. Now, the idea once you buy your house with a B lender is that we show that you have 2 years straight of good repayment history. After that, we can switch back over to an A lender as long as your credit score is still as long as your credit score is still good and you've made all your payments, not just to the mortgage lender, but also to the credit card companies, auto loans, all your standard access to credits or sources of credit. So as long as you've showed good repayment history for the past 2 years and your income still qualifies, then we should be able to switch over from that B lender over to an A lender and get back into that prime rate lending. So the process to refinancing your mortgage with bad credit is very similar to purchasing your house with bad credit. What that means is that you can access up to 80% of your home's value with bad credit, although you will pay a premium for doing so. So whereas right now the interest rate on a normal refinance, if you have good credit, is 2.24. If there has been some credit issues, we can be looking anywhere between 3 and 5% interest on refinancing your home. So that is taking equity, taking money out of your home. So when you refinance your home, you can do that for renovations. You can do that to pay off credit cards, pay off auto loans, pay off lines of credit. And that often will help you lower your monthly obligations, which will actually help you improve your credit. So similar to the home purchase, the lenders will want to see an appraisal to make sure it's worth what we're saying it's worth. And you can access up to 80% of that funds with 20% down, like with the purchase of your home, being sort of your down payment with those B lenders. Most B lenders will include a fee. Usually it's a 1% fee, but that gets included right into the mortgage. So it's not like it's out of pocket for you. Similar to the home purchase, refinancing with bad credit is very similar with the timeline. So the idea is that you refinance your house, clean up any collections that you have, any credit cards, any bad debts. You do that for a 2-year period. We're on a 2-year term, and after that 2 years, you switch back over to an A lender and get those much better rates. So now that we've gone over what's considered bad credit in Canada, how to get approved for a mortgage on a home purchase with bad credit, and refinancing with bad credit, let's just go over some brief tips for how to improve your credit if you anticipate getting a mortgage in the short to near-term future. First, number one, always, always, always pay off your collections as soon as you can. Prime rate lenders want to see 2 years between your last major issue with your credit and the moment that you apply for a mortgage. So if you can pay off your collections right away and get that clock running, the longer time that you have between when you had a collection on your credit bureau and when you apply for a mortgage, the better you look to a lender. So because it shows that you can continue to manage all of your sources of credit, and it starts to really build your credit history. Second, try to keep your balances low on your credit cards. So it's a really good idea if you're to keep at a 50% utilization. Even less is better than that. If you can be below 30% utilization, that's great as well. But below 50% is still really good. So if your credit card has a limit of $1,000, try to keep the balance below $500. That will greatly help you improve your credit. Third, try to avoid applying for more and more credit. Lenders really only want to see two sources of revolving credit, that's credit cards or lines of credit, for a 2-year history in order to qualify for A lending. They want to see good repayment history on that 2 years, but they just want to see those two sources of credit. When you start applying for credit card after credit card or auto loan after auto loan, then it starts to look, then the multiple credit checks show up on that bureau, and you could be labeled as a credit seeker, which makes it look like you're trying to gain as much credit as possible, when in effect it actually lowers your credit score because it's more checks on your credit bureau. So try to limit the amount of times that you check your credit score, that you apply for credit. It's fine to check your credit score on say Equifax.ca. That won't hurt your credit. But when you apply for new credit, when you apply to get an increase in the amount of credit that you have, that will actually hurt your credit. First and foremost, pay those collections off. The more amount of time you can put between having the collection paid and applying for a mortgage, the better off you'll be. Second, try to make sure that those balances are kept low. So try not to use nearly as much credit as you have access to. And third, avoid applying for new credit if you can. That will definitely help improve your credit, which will help get you a mortgage at a much better interest rate in the future. So in conclusion, it's definitely possible to get a mortgage with bad credit. There are some steps involved, and you will have to go with a B lender. So there will be a rate premium involved, but it is definitely possible to get that bad credit mortgage. The main thing being that you need to have a 20% down payment and no collections. Those are the two main prerequisites to getting a mortgage with bad credit. You do still need to be able to income qualify, and the house has to be worth what we say it's worth. But if you have the down payment, the income qualification, and no collections, then we should be all set, all things being equal, to buy a house even if you do have bad credit. Further, if you do want to refinance and clean up your credit to lower those monthly interest obligations and improve your credit, you can access up to 80% of your home's value. Do that for 2 years and then switch back over to an A lender and get a much better interest rate while saving a lot of money that you're not paying on your credit cards in the meantime. And finally, try to follow those three tips about keeping those collections off your credit bureau, keeping a low balance on your credit card, and not applying for too much more credit. Not more than you need, most definitely. If you have any comments or questions, please do list them below. And if you like this video, please do click like and share. And you'll receive mortgage rate updates to new programs, and brief looks and analysis on the Canadian mortgage market and the Canadian real estate market, specifically here in London, Ontario. Thanks for watching.